Hello everyone, welcome back to Banking and Finance with Chitrak. Today, we will continue with the explanation of the chapter of AML KYC exam.
Now we'll understand the risk categorization of customers. Basically, the rule 9 of 13 of the Prevention of Money Laundering rules of 2005 requires the regulated entities to carry out the risk assessment to identify, assess and take effective measures to reduce the money laundering and the terrorist financing risks. This risk assessment should be documented and reviewed with time to time, and the Financial Action Task Force or the FATF has also provided some risk based approach or RBA. Now, this customer risk categorization is the key to modulate the anti money laundering and the financial terrorism countering efforts. There are two broad levels of risk assessment: the enterprise wide risk assessment or the EWRA and the customer risk categorization. Now, what are the factors which impact the money laundering and terrorism financing risks? First is the customers. Certain customers, like the low income salaried employees or the small business owners or real estate dealers, they have lower risk. Then, certain products like savings account, term deposits, they carry lower risk, but current accounts or remittances has higher risk. Then, delivery channels, transactions from branches are easier to monitor than those through net banking. Then, cash intensive businesses or crime centers has higher risk, so it depends on the locations. Then, certain geographies like the jurisdictions harboring the terrorists or facilitating suspicious transactions has higher risks. Now, the objective of risk categorization is to allocate the resources suitably. The number of categories can be determined by each bank, but the minimum categories are low, medium and high risk. What are the differential measures? KYC AML measures are differentiated according to the risk category, and more intense approach is taken for higher risk customers. What are the different measures? The customer identification and due diligence or CDD, customer KYC profile monitoring and updation, and the transaction monitoring. These are the basic measures. Now, this money laundering and terrorism financing depends on the customer's characteristics. The parameters which impact the risk categories are here. First, the entity parameter. The customer can be a constitution or its background or social status is important. Geographical parameters include the country of residence, the country of origin, country of the company or incorporation, location of the customer, and location of the customer's clients. Financial parameters, financial status of the customer, the expected annual income, the expected annual turnover of a business, or the expected annual value of other services. Then the activity parameters are occupation, the profession or employment of the kind of business activity the customer has. Linkage parameters means the sources of funds received or the modes of payment done. Relationship parameters includes the banking accounts held by that customer, the banking services it availed, and the para banking services it availed. There are some also other parameters like the status of the account, if that person is present in the caution lists or the media report of that particular customer, also impact the risk category. Now, risk rating model or system. What's the objective of that? It captures various parameters with scores and weightages. What are the inputs for this risk model? The size of the customer base is considered, range of different customer types and the customer's businesses, geographical spread of that financial institution, and if any cross-border activities are present. This risk rating is auto-generated and is done after the completion of customer profile. So, when a customer comes to open this account, all of these inputs are considered, then a risk or an auto-generated risk is given to that customer. How to determine this risk rating? The risk rating model should be score based with ratings assigned based on profile inputs. The customer risk category is not based on single factor but is resultant of several factors, like only the country of origin or the age or the kind of businesses maybe, but generally doesn't determine the risk factor. A lot of things are considered before determining it. This model, as I said, can however include overriding provision for higher or lower risk categories. For example, a customer can have a good business, a good turnover, can have good media reports, and that person may have also a good customer profile. But the profession of that customer, if diamond trading, then irrespective of other good factors, he will be under the high risk category due to the feature of the trade he does. Some examples of customers in various risk categories are given here. Low risk customers are low income persons like hawkers or plumbers or cobblers, pensioners, salaried individuals but who are not in senior management or controlling positions, housewives from low or middle income families, non-profit organization promoted by UNO, and etc. Then medium risk categories customers are real estate agents, restaurant owners, electronic good merchants, cloth merchants, travel and tours agencies or transport companies. High risk at risk customers are diamond merchants, arms dealer, real estate developer, promoters, persons in senior controlling executive positions in the private sector, importers and exporters, politically exposed person, non-profit organizations. Now, the banks must maintain a profile for each customer for the effective anti-money laundering and countering the financial terrorism implementations, and this profile should be updated regularly based on the risk category and customer characteristics. The templates for basic customer profile requirements have been standardized now through the central KYC or CKYC records registry. Additional customer information may be required based on the business relations and complexities, including information from FATCA or the Foreign Tax Compliance Act of the USA and the CRS or the Common Reporting Standards to enable international transactions. This data is also used for the AML or CFT monitoring and reporting. Then the customer privacy is very important. Confidentiality of the customer information must be maintained, and banks must obtain consent if information is for the purpose other than what it was collected for. Also, the information collected should not be divulged to others for commercial purposes. Strict privacy should be maintained and included in KYC policy documents. Now, we'll discuss about the risk categorization of various products of a financial institution. We know banks or any other financial institution provides various kinds of products and services. But these products and services are also impacted by the money laundering and terrorism financing risks. The basic factors of products or services that have these risks are the flexibility of deposits or withdrawals, amount of cash transactions permitted in the facility, restriction on source of funds, how much anonymity is provided to the customer, if the product has domestic or cross-border transactions, the types of users the product offers, the transaction values permitted by the products, the flexibility of the products, and the ease of identification and detection of it, number of parties involved in any service, or the complexity or combination of different products. Risk categories of some products or services is given here, like term loans against assets or consumer loans or fixed deposits fall under the low risk category. The fixed deposits by a non-resident or credit cards or demand loans are at medium risks, but cash credit, project loan or diamond dollar accounts fall under the high risk. Some new technology products like global cards or remittances through net banking carries higher risks as they have provided anonymity and ease of access around the world. Let's discuss about the risk categorization of various delivery channels. So these delivery channels is another factor contributing to the money laundering and terrorism financing risks. The different modes of sourcing customers are direct sales agents or partner agencies like the microfinance institutions or cooperative banks, business correspondents, net banking or own website, net banking through social websites or mobile banking. The modes of delivery services are ATM machines, partner agencies, business correspondents, point of sales like merchant establishment, phone banking, net banking through websites or the social websites, then mobile banking or outsource agents for CMS. Now, the factors which impact the money laundering and terrorism financing risks in delivery channels or sourcing mode are ease of customer verification by bank staff, interaction of bank staff with the customer, involvement of intermediaries, adequacy of information and documents for the transactions. So, any services or any source of customer from the branch has a low risk category. If the delivery channel is through ATMs or any BCs, then it has a medium risks. But when that customer is service of his own using phone banking or net banking, then the category is high. Let's discuss about the customer due diligence. The first step in KYC is to establish a customer identity. And the goal of the KYC is to have a customer due diligence present. So CDD includes measures undertaken by any financial institution to collect, verify the information and positively establish the identity of the customer and understand the nature of activities of the customer and satisfy that these are all legitimate. So the ultimate goal is to be satisfied with the true identity and the actual activity of the customer. The methods of independently verifying information includes the field visits, inquiring with neighbors, inquiring with customers, suppliers, interaction with other acquaintances, and scanning media reports. The extent of information obtained depends on the level of risks perceived. So, if someone has higher risks, then the customer due diligence should be more intense. There are basically three types of due diligences. One, the basic or the normal due diligence, and this includes obtaining the prescribed KYC documents and collecting basic customer information as required. The minimum information obtained is typically applicable to medium risk customers. So, what kind of information we can take? The particulars of the activities or occupation of the customer, the expected turnover of the business, the average balance maintained in other accounts, and the income of the customer. But in cases of higher risk customer, more details are needed. Also, it's important to capture a specific description of activity and expected transaction pattern for the effective anti-money laundering monitoring. Then we have the simplified due diligence or SDD. This is for low risk customers and provides greater flexibility in OVDs and allows for less detailed customer information like the basic identifiers or the basic activity or income or basic what is the turnover or average balance. Now this is specifically done for financial inclusion, like certain categories of person who has no income or not in a position to provide OVDs may have relaxed KYC norms to ensure that they are not detached from the financial institutions. There is also a scheme to open small account for these people. Then we have the condition to obtain introduction. Even though the regulatory doesn't obtaining an introduction nowadays, but if it is being provided by the customer, it can be treated as additional due diligence. Then we have the enhanced due diligence, which is basically for the high risk customers, and the additional due diligence may include collecting copies of the financial statements, business licenses, obtaining information of organization setup, details of the manufacturing or trading activities, and making inquiries with the customers or suppliers, doing media research for the entity, beneficial owner or associates. Now, screening of customers. What is this? Banks are prohibited from opening accounts or providing services to entities with criminal background. So, we need to screen the background of the customers. We can determine the person's identity and other available details from various sanction lists. Sanctions list advised by RBI and FIU must be mandatorily included. There should be arrangement for keeping the lists updated. Screening process must be done for all customers regardless of the risk category. Incremental records are used to ensure that any existing customer is not included. Appropriate IT application is needed for screening such customers, and false positives should be scrutinized manually. Unusual matches can lead to account freezing or transaction undertaking. Then several service providers offers the list that a bank can subscribe to for this purpose. Then we have the field verification. KYC process relies on documents, but identity must be ascertained through checking the credentials independently. What are the factors influencing the verification? The customer risk category, the nature and the value of transactions, locations, extent and nature of field verification. The verification comprises of the visits to residence and place of work, inquiring with the neighbors, colleagues and employers, and visit to office, shops, factories or workshops, inquiring with other customers or suppliers or other business associates, and observing signs for unusual or abnormal conduct or appearances. There are also other modes of customer due diligence apart from the field verification, which can be some innovative and simple technique like the intelligent conversation with the customer covering different aspects, obtaining additional documents or information, telephonic inquiring with social or business contacts, media search on the internet, studying the documents of the financial information provided by the customer, information on the characteristics of the industry or activity the customer is engaged in, and matching the customer's turnover and other financials with the industry level data. If a customer is acting on behalf of other, then the legal arrangement must be recorded and the reasons for such arrangement must be understood very clearly by the bank or the financial institution. Now, what are some concerns of customer due diligence? There may be some situations where the banks may not be able to carry out the required due diligence, not verify the identity or the required documents obtained from the customer cannot be obtained due to customer non-cooperation, or the documents which have been provided may be non-reliable. So in such cases, banks should definitely not open an account for the customer or close any existing account. Now, let's discuss some cases of customer due diligence where some suspicious can be arrived. First of all, doubtful PAN card. Bank will not open an account if PAN and voter ID card do not appear to be same, or if photographs from PAN and account opening form do not match, or if field verification was not done where the applicant lives. So, if the applicant was not traceable in the given address, or if the people around the area doesn't know about the customer, then the account shouldn't be opened. Not residing at given address, like I said, banks will not open an account if the customer submits paper for opening a savings bank account, but the driving license and declaration of communication address are provided, and after verification it is found that the customer doesn't reside in that area. Then original document not available. Bank will not open account if the customer submits paper for savings bank account or current account in the name of a proprietor, but the original documents for the firm or the customer is not available. You need to check the original documents before opening any account. Banks will not open account if the birth certificate appears to be altered or suspicious. Now, let's discuss about UCIC, or Unique Customer Identification Code. UCIC is a common marketing and money laundering risk mitigation tool. It ensures an integrated view of the customer activities. And the different steps are assigning a UCIC to each customer. For new customers, deduplication should be undertaken based on unique identities like the date of birth or PAN or mobile number. Linking various accounts or services used by the customer should be done using the UCIC. UCIC improves monitoring, profile maintenance, and reduces the burden on customers for KYC documents. The risk categories should be reviewed regularly as customer behavior can change. First, periodic review. The RBI guidelines require customer risk categories to be reviewed at least every 6 months based on the transaction with the bank, and this can be automated. Event-based review. Review of customer risk categories can also be triggered by certain events or any transaction that carries risk to the customer's identity or activity. What can be some of the examples of events which lead to a high risk category? Like demographic details, when a customer moves to a high risk country. Account status, when a dormant account suddenly gets activated and a lot of transactions goes on. Account vintage, when the customer appears in negative lists, when he becomes a PEP or politically exposed person. Sudden spurt or unusual transactions or complex transaction can lead to anti-money laundering alerts, or any suspicious transaction reports is filed. We'll discuss about the periodic updation of KYC. Periodic updation means steps taken to ensure documents, data, or information collected under the CDD process is kept up to date and relevant by undertaking reviews. What's the purpose of this? To ensure banks' awareness of customer status to mitigate the AML monitoring. What is the periodicity? This is very important. High risk category customers should be reviewed every 2 years, medium risks every 8 years, and low risks every 10 years. Time limits are applied from the date of account opening or the last KYC updation. What are the KYC updation requirements? Basic requirements are reconfirmation of the identity, address, and other particulars. KYC documents and fresh photographs may be obtained, especially for medium and high risk customers. Challenges faced by banks can be constraint in reaching the customer. Customer may not want to give the KYC documents again, and it can be a tough exercise because getting KYC of all the customers every alternate 2 years is very tough. So the RBI has laid down some simplified electronic modes like getting the documents through mail or photographs as a simplified process. Now, individual customers. These are divided into 3 categories. One, someone who has no change in KYC information. Those customers can provide a self-declaration stating that no change in KYC is required, and it can be received in person through courier or email or mobile number registered or the ATMs or other digital channels. If someone has changed their address, then a self-declaration is sufficient, but it can be verified by positive confirmation within 2 months, like the address verification letter. Accounts of minors turning major. If any minor becomes major, fresh photographs must be obtained and CDD documents verified to meet the current KYC requirements should be done. If customers other than individuals exist, no change in KYC information for such customers, then self-declaration can be obtained and beneficial owner information must be verified to ensure the availability of the information on records. Latest certificate from statutory auditor may be taken for confirming the BO details. But if there is some change in KYC information, the regulated entity undertakes the KYC process equivalent to that applicable for onboarding new customers. So, what are some additional measures? Ensuring the KYC documents for current CDD standards are available, ensuring the documents are still current, verifying the PAN details of customer with the issuing authority or intermediary, acknowledging the date of receipt of documents or self-declaration, facility to furnish the sealed declaration or documents at any branch, policy for KYC updation should be transparent, adverse action against customer should be avoided unless provided by regulations. There are some higher level measures which also can be adopted, and these are specified by RBI with the board approval. It can be obtaining the recent photograph, physical presence of customer for updation, periodic updation only in branch account where it is maintained, and more frequent periodicity of KYC updation. Now the requirement of PAN. Not providing PAN or Form 60 implies temporary suspension of all transaction or activities for the customer except recovery in loan accounts. Operations resume on client submitting the documents. KYC policy should contain the provision for relief to customers who are unable to provide the PAN or Form 60 due to any injury, illness, or any other reasons, and the accounts then will remain under enhanced monitoring. And if a customer refuses in writing to provide PAN or Form 60, then the account should be closed and dues paid after proper identification. So the chapter is completed. This was a big chapter and a lot of details was included in this. This is a very important chapter in respect to the exam. So I hope this was helpful to you. And if you need the notes, check the description box and the comment box to find a link, fill up the link and get the notes. So thank you. Please like, share and subscribe. And if you have any queries, do comment below. All the best for your exam.